Hello everyone, my name is Aaron Phillips and I'm a income tax advisor here in San Francisco. So I wanted to make this video because I have more clients than ever before who have new jobs. And it's because of COVID, people are moving around, they're changing employers. And I want to talk about how you can save taxes by utilizing some of the employer benefits that may be available to you. So whether you have a new job or you've been with the company for a while, what I want you to do is to sit down with your human resources department and go over all of the benefits that they offer. So in this video, what I'm going to do is I'm going to talk to you about some of the benefits that you want to ask for. But there's a new one that's really important that has to do with COVID. So think of it this way. Across the country, people are working out of their homes, they're working remotely, and they're incurring costs that they never had before to allow themselves to continue to work. For example, internet. That's a great example. Who's paying for your internet? So prior to 2018, you could take a tax deduction for any unreimbursed employee expenses that you incurred. Maybe you had to drive for work, or you had office supplies, or maybe meal expenses. These are things that you could always deduct on your tax return if you itemize your deductions. The problem is that the 2018 tax law, it cut all of these deductions out. So it left people without a tax deduction. Now, before I go on, I'll tell you that many states, especially California, still allow a tax deduction for these unreimbursed expenses. So it's important for you to keep track of them. But there's another way for you to take these deductions federally. And what you can do is ask your employer, say, hey, do you offer an accountable plan? And I'm going to say that again, it's called an accountable plan. And what that is, it's a little bit like an expense account. In other words, if you have expenses that are necessary for your job, what you do is you keep track of them, keep the receipts, and you provide your employer with a periodic expense account or expense report. And then what they'll do is they'll reimburse you for these expenses. So in other words, these are expenses that are coming out of your pocket that you can get your employer to pay for and reimburse you. So they're essentially tax-free. Now the caveat is that if the employer gives you more than what you spend, you've got to give that money back to the employer. So again, if the employer does not have an accountable plan, ask them to set one up. Because if they don't have a plan, you can't take these deductions. So let's talk about some of the other tax deductions or employer benefits that are going to be available to you. So the biggest one and the most important one is a retirement account. Now, most large employers will offer you a 401k. It's super important that you contribute to the account, and if you can, always try and maximize it. Now, in 2020, you can contribute up to $19,500. If you're under 50, if you're over 50, you can contribute an additional $6,500. So again, every employee should be taking advantage of the 401k. But there's two caveats. Number one, ask your employer if you can make non-taxable or non-tax deductible 401k contributions. What this is, let's say you're a high income earner. You've maxed out your 401k, you've put in your $19,500. What you can do is you can take money and you can add it to the plan, significantly above the contribution limit, and this money goes into the 401k, and then when you leave your employment, that money can be rolled into a Roth IRA. So the beauty of a Roth IRA, for those that don't know, is that you put money into the retirement account, and when you take it out, it's not taxable. Also, the gains are not taxable also. So it's a phenomenal way for you to set money aside for the future now and not have it and grow tax free, and when you take the money out, it's not taxable. The problem is there's lots of limits on these accounts. If your income is too high, you can't contribute to a Roth IRA. But if you can contribute to a after-tax 401k, then it's a tricky backdoor way that you can set money aside in significant dollar amounts and have it flow into a Roth IRA. So the other thing you want to ask your employer about is, do they offer a Roth 401k? So, it's kind of like a trade-off. If you think of your financial advisor and your tax advisor, we are continually having a tug of war whether you should contribute to a Roth 401k or a traditional 401k. A tax advisor will always tell you, take the tax deduction now because you don't know what the future is going to look like. The financial advisor is always looking over the long term, over your entire life. In many cases, making a Roth 401k contribution can be more beneficial over the long term than a traditional 401k. But there's a caveat. If you're in a high tax bracket right now, 37% plus state taxes, you're going to get a huge tax deduction if you contribute to a traditional 401k. And let's say when you retire, you move to Costa Rica, you're managing your assets in a way so they're not taxable, then your tax bracket is going to be really low. So it's better to take the tax deduction now, because in the future, when you pull money from that 401k, you're going to be in a low tax bracket. It's not going to be as painful. But if you're in a low tax bracket now, and possibly the same or a higher tax bracket when you retire, then oftentimes it's more beneficial to contribute to a Roth 401k. This is especially important when you're younger, and again, you're earning a little bit less, you're in a lower tax bracket. So talk to your tax advisor. So again, with this employer benefit, do you offer a Roth 401k, and can I make after-tax 401k contributions? So a couple of the other benefits that you want to ask for is, number one, if you have a child and they're in daycare, you can set aside up to $5,000 of your pay into a dependent care account and have it not be taxable, and you can use that money to pay for your daycare expenses. So it's called a dependent care account. So that's a huge benefit. Another benefit is called a health savings account. Now, HSA is the acronym. If your employer offers a high deductible health insurance plan, then what they can also do is allow you to contribute to an HSA. The beauty of the HSA, this is money that you put in or your employer can put in also, so it's free money and it's triple tax free. So the money goes into the account. You can use this money each year to pay for prescriptions, doctor co-pays, glasses, Band-Aids, whatever you need. The key though is you can't use it to pay for health insurance. But what happens to this money is it goes into the HSA account and it grows. It's invested. And if you don't use the money, it doesn't matter. It continues to grow. So the idea is that while you're employed, if you can contribute up to $3,550 as an individual, $7,100 if it's a family plan, you can contribute more if you're over 50. But the idea is this money goes into the account, and it's like a savings account that will grow tax-free into the future. And as you stop working, you can continue to use it each year to pay for these types of medical expenses. Another really important tax deduction or tax benefit that every single employee should ask for is, does their employer offer an educational benefit? In other words, an employer can give you up to $5,250 tax-free for you to pay for educational expenses. So what I always tell clients is that you want your life and your career to be sustainable, something that you're going to want to do into perpetuity. Have a career and a life that brings you joy and excitement. You love coming to work. You're learning. You're growing. So each year in your life, you want to be taking classes. You want to be learning. You want to be growing. And what's bad, the best thing is if you can get your employer to pay for that, themselves, it's a phenomenal benefit. So again, ask your employer, do you offer an educational account? Do you offer a HSA, dependent care, a Roth 401k, after-tax 401k? And most importantly now in 2021, in 2022, ask them, do you offer an accountable plan to reimburse me for my unreimbursed employee expenses? So I hope this helps out. If you have any questions, talk to us or talk to your tax advisor. Also, if you enjoyed this video, if it was helpful, please subscribe to my channel. It helps me out and it helps me to disseminate this information and get it out to more people. So thank you very much and have a wonderful day.